Welcome to NDTV Profit. I am Muralidhar Swaminathan. Today we are looking at the Portfolio Manager show, and today's Portfolio Manager is Jyotivardhan Jaipuria. He is the founder and MD of Valentis Advisors. Jyotivardhan has been a veteran in this industry. He was with DSP before he launched his own advisory firm and a portfolio management firm. Jyoti, thanks for joining us. Welcome to the show.
Thanks.
Okay, so Jyoti, I would request you to introduce your fund to our viewers, your strategies. What is this PMS scheme all about? It's just about 5 or 6 years since you launched, I suppose.
It's more than 7 years now since we launched our first scheme. So we have two schemes over there. First is what we call the Rising Stars Opportunity Fund. So that is primarily a small cap fund by today's SEBI market definition. So 70 to 80% of our portfolio will be less than 10,000 crore market cap. What that aims to do is buy the blue chips of tomorrow. So we buy stocks today which are generally not known. And, like 3 years later, 5 years later, everybody will know about the scheme. The other scheme is what we launched 5 years ago, which was our Multicap. So that's like a classic Multicap with some exposure to large cap, some exposure to mid cap, and some exposure to the small cap. And, so probably a third of the portfolio here will be have stocks which are there in a rising star already. The idea of the multi-cap is what it does is the small cap scheme, the rising star scheme generally gives a very high return. At the same time, it comes with more volatility, which is inherent to the asset class of a small cap portfolio. So to that extent, this one is trying to reduce the volatility even at the cost of reducing the returns. Both the schemes are run in one very same way, which is research, and more research is our mantra. So we focus on deep fundamental research in the company. Our churn ratio is very, very low. We have like a churn ratio of like less than 20% in both our schemes. In fact, it is lower in the Rising Star than it is in the Multicap. One other philosophy which we have is what we call the 3 U's. So we buy undervalued stocks, which obviously everybody does, whatever way they define undervaluation. But we are very happy to do underowned stocks, very happy to do undiscovered stocks or underperforming stocks. So, that's one of our core philosophies. The research is our strength, and very, very deep fundamental research goes behind most of our stock picks.
Okay, that's very interesting. Undiscovered stocks, undervalued stock, or whatever you may call it, hidden gems, if I may call so. What is for beginners? What's the ticket size, minimum ticket size, if somebody wants to get into your fund?
Our ticket size is 1 crore generally, so we don't want to do less than 1 crore. The SEBI minimum obviously is 50 lakhs, and we try to keep it a little higher, and because we want people who understand the philosophy. We want them to come for 3 years, 5 years. So what we tell our investors is, unless you're thinking of like a 3-year, 5-year vision, don't come to our scheme, because it is not really meant for people who want to come in and go out.
Right. And if somebody wants to come in today and put money, what are the other terms that would be required? I'm just helping viewers understand so that before we go on to talk to strategy.
So obviously, like, we have fees which are very similar to what a lot of the other PMSs charge. But one thing, because we don't want short-term money, we have an exit load for 3 years. And that is something which we are very clear on, that we don't want people who are looking at very short term. So the exit load is something which we typically insist on.
Right. Okay. So my next question to you is, if somebody wants to come and put in, let's say, 1 crore, what will you tell them? Will you tell them that, look, at this stage of the market, I won't be able to give you X, Y, Z return as opposed to what it was the last year? Because I guess that's the beginning of the conversation.
Yeah, so, see, we never really try to give a return numbers per se. And, that's something which, even like if you go through all the SEBI regulations, you're not supposed to give any return guidance when people come in. What we obviously want to do is we want to create alpha, and we have a track record where we have sustainably created alpha, and we created large alpha for portfolio investors. So that's something which people want to look at. Typically, we tell people a lot of the risk, because especially like if you come in Rising Star, it is a volatile portfolio. It will go down when the markets go down. The other thing is where we are today positioned in the market. It's not a cheap market. It's a market which has done very, very well, and it's relatively expensive compared to history. We think returns over the next 3 years, 5 years will still be made because earnings will be good in India, the economy will do well. But it's definitely not a market which is like a very easy market that the chances are that you will see volatility over the next 6 months, 1 year, returns will be quite muted. In fact, the other thing which we are doing now is we are telling all our investors that we are not going to invest your money in which one shot, but we'll probably stagger it over the couple of months, depending on how the market goes. So we want to invest slowly rather than invest in one shot and keep some money just in case we get a correction in the market. We want some money to be available to invest at that point of time.
So which leads me to the next question. How much cash are you sitting on in the old portfolio? How much cash will you sit on if somebody comes in afresh?
In the new portfolios, what we are typically thinking today is we'll invest over 8 to 12 weeks. If somebody's come in, let's say a month ago, it's possible that we are sitting on 50% cash in this portfolio. In the old portfolios, we were fully invested till some time ago. We built cash of around 7 to 8% in the old portfolios by selling something. And this is again, we're keeping, like I said, we're keeping it as insurance that at some point the market will go down. So if you look at overall as a firm, we are sitting on close to 17% cash. But like I said, there's a difference between the new and the old portfolio, but overall we are sitting on close to 17% cash.
That would be your overall portfolio both together will be about 1,500 crores, the size of the fund?
Yeah, a little less than that. It's around 1,250 crores.
1,250 crores. Okay, excellent. So before I go to the next question, what I want to look at is now in terms of you're sitting on cash, whether it's 17% today or 18% tomorrow, it doesn't matter. Suddenly, there are days when the markets tank. Do you jump in and say that I will buy on this day, or will you stick to your philosophy of what my research has guided me?
For like the simple answer, we stick to our philosophy that we want to buy stocks at a certain price where we are comfortable with. Uh, very often what we do is whether the market is going up or down, we may want to buy something at X price, and that price could be like 5% lower than the market. It could be 10% lower than the market. It's more like, okay, at these levels, we feel that, the risk reward works out to be good. And we are generally patient and we're waiting for that sort of price to come. On down days, we do find that one or two of those stocks reach our level at which we want to buy, and we end up buying at those levels. So it's not like it's not a 0-1 game because, you're sitting on cash, so you want to deploy 1% today, you want to deploy 2% today, and it may happen that one stock has fallen, so you end up buying that stock on that day.
Okay, so at this point in time, I'm sure your research would may not match the price that you want, So you might have a bunch of stocks where you know that, look, they are not in my portfolio, but they are not at the price I want to buy. Do you have those kind of stocks? Would you like to name them, or would you like to mention what kind of stocks that you are there, which are in the waiting list, if I may say so?
Yes, you see, without naming stocks, there are like two types of stocks, right? One is there are stocks which are already in our portfolio, which we want to buy, but we may not want to buy at today's prices because we think they'll still do well. But if we can get lower, then we can, make even more return on it than we can make at today's prices. So typically, some of these are in the engineering space, some of these are in the banking space, and some in the cement space. So just to name a few sectors. So what we may be doing here is, let's say a new portfolio comes and we want to put 8% weight into that stock. We may at some point go and buy 3-4% weight in that stock and say, on correction, we'll probably add another 3-4% weight to that portfolio. And there's another set of stocks which are not there in our portfolios at all, which is, we don't own them at all, but we do want to buy them if we can get like a pullback and we can get prices looking very sensible. Some of these are actually in the banking stock, which we are looking at today, that these banks have done quite badly. And if we can get them cheap, then we do want to buy them. So there are banking stocks which we want to buy. And there are a whole lot of other sectors. The waiting list normally is very, very large, linked to some prices and linked to some events. So now, even some chemical stocks are starting to come on the horizon because we've not owned them for a long time. But now that they've corrected, there are some chemical stocks which are starting to look interesting. And we may at some point go and buy them also.
Jyoti, the next question I want to ask you, let me focus on the Rising Star Opportunity Fund. Here, the kind of returns, it's primarily 75 to 80% small cap largely. Now, how many small caps do you have in this fund, and what kind of small caps are they?
So see, typically the portfolio has 50 to 16 stocks. So in some sense, it's a very concentrated portfolio if you compare it with, let's say, the mutual funds. And so because we have 15, 16 stocks, typically the weight of each stock, minimum we like to have is 5% weight in a lot of these portfolios. Now, it has a mix of stocks which are not known today and which we think will be known 3 years later. And some of the stocks have now got known and, they're generally beaten. But most of the time when we buy the stock, we are looking for disproportionate return in this. So our whole analysis works on what will it take us to double this money in the next 3 to 4 years. And that's the way we start like a lot of our analysis.
How many of these stocks have doubled their money in the last 3 years, if I may ask?
Oh, so last 3 years, I think most of them have done, but frankly, last 3 years is not an indicator because it's been one of those very easy phases, right? Because this is post-COVID. So, like the fund itself has done some crazy amount of return, but that may not be like a great way to look at it because we had this COVID base, which created a lot of problems. So what I can say is, over the period since we started the fund, we've had at least like 3, 4 stocks which are up like 7, 8 times in 5 years. So that would be an interesting way to look at it. That you managed to get quite a few of those multi-baggers there.
Okay, so I think essentially we should call it as a multi-bagger kind of a portfolio over a period of time. If I can take one example, I want to understand how you have spotted these companies and why have you invested and what is your conviction here. For example, Ganesha Ecosphere is your top holding. What drove you to look at this stock?
So, without getting too much into specifics, because, we'll end up with some compliance issues.
Sure.
So, in general, if you think about it, recycling and pollution is going to be a big theme for the next 5, 10 years. Uh, pollution is a theme because we are getting more environment conscious. And, India signed a lot of these, climate agreements also. And the Prime Minister himself is very, very aware of it. So if you think about it, like we all have PET bottles, we use them. The bottle in which you have Bisleri, the Coke bottle, the Pepsi bottle, all these are PET bottles. And plastic, as you know, does not just naturally get into the waste, so it needs to be recycled. The government of India has mandated from next fiscal year that all the bottlers will need to have a certain amount of recycled material when they make the bottle. So it's like what happens with this bottle, PET bottle, is you can crush it and create PET again, which can be used to make bottle again. So in some sense, it's a whole recycle chain that you buy a Pepsi and the empty bottle is converted back into a bottle by crushing it and taking PET chips out of it and making a bottle again out of it and ensuring all the safety and quality standards so that because it's a food grade product. And so that will be a very big thing for most of the people like Coke. Just in general, I think they want to move to using 80-90% recycled material over the next decade. So most of the Coke bottles or the Pepsi bottles will be from recycled material rather from virgin PET. And it's companies like this which will stand out a lot because the whole ecosystem is going to move in such a way that they will have a lot of demand in future. And if you can build a sustainable model around it, you can do very well with it.
Right. So, as an extension of that theme, yesterday I looked at a very interesting piece of news. Balrampur Chini is looking at making plastics out of a particular chemical made from sugar. I think it's called polylactic. That's a very interesting. So, there is some innovation happening. Do you also look at companies which go in for such innovation?
Yeah, so we are very open to it. So we never say never is like a philosophy to anything. It's more like, can we understand it well? Because we are not probably great technology guys. So sometimes, it's something, can I understand it simply or not? And the second is it little more sustainable? Because, we're not venture funds. So we can't afford to bet on somebody who, the technology may or may not work and it may take many years. So we may get in at a later stage, venture capital gets at some stage. We'll get in when the technology model is discovered, or at least proven that, okay, this is going to work. So for us, we are happy to look at a lot of this space. In fact, for us, it's a theme. So there are lots of these recycling companies or companies which will do very well when the tech environment comes around, which we want to play in. At the same time, we don't want to go and bet on, like, we don't want to bet on somebody who's starting to do R&D on something else.
Right, very interesting observations. I was looking at the sector allocation and I find that infrastructure has got about 16%, capital goods about 10.75%, auto ancillary 9 point, more or less evenly distributed. What in infra one can look at? Are they road builders? Are they kind of the bus makers or the EV battery makers? What kind of infra are you actually looking at?
So, it's very interesting because the reason we took Infra, and, one of our themes was we prefer investment theme over consumption theme. And that's been a theme right from, 21, that we think investments will do well. The logic for that was two. One was our whole three-use philosophy. So, the consumption theme was overvalued, whereas the infrastructure was undervalued. It had underperformed a lot, and most people didn't own it, so it was underowned. The other was that the government, if you see, as a invest government capex as a percentage of GDP was going up, and it was going up like every. If you see every year, the percentage was going up. So in the last 5 years, more or less doubled as a percentage of GDP. So it was like we have to play that government capex. Now, one thing which we played, and this sounds not so much, the Prime Minister came with this Har Nal Jal, which was water at every tap in the villages. And that was something which we played in a big way because one of the gainers from that was putting up the pipe companies. So we bought a lot of these pipe companies because one is, additional demand would come from this Har Nal Jal program of the government. And the second is the pipes were anyway doing well because of all the infrastructure thrust from the government. It was a sector which we picked up like close to 4 years ago. And today that sector now is become universally loved. Everybody's buying it. A lot of the mutual funds own it. But at that time, we had picked up a couple of very small companies in it. Most of them have become like, a multi-baggers now. So it was like taking a very small segment of the government spending, which was not a crowded space, not very well known, and starting to, play out of that. One thing which I always like in these companies is I don't want government sales to be more than 20-25% of total sales. So that is something which you're very, very on. So when you're comparing this versus road building companies or something, for us, this was the advantage that, okay, if the government sales become very large, then your balance sheet, if they don't pay you on time, the balance sheet starts to get strained. Whereas
Correct.
if the it's at 20-25%, then you can do much better with it.
Right. Okay. So I think it's time to switch focus to multi-cap. I think the market is also now moving away from mid and small to large caps. What's your strategy for multi-cap, and what kind of returns do you think you would be able to deliver? And today, would you lean more towards large caps within multi-cap?
Yes. So, like within the multi-cap space, we are adding to the large cap and selling or reducing the weight of the small cap. And the reason for us was very simple, right? It's valuation. Again, I just go back to the three use philosophy. So relatively, the large caps have become overvalued. Relatively, the large caps have outperformed a lot. And, that's where the ownership has built up over the last couple of years. So we are, basically switching more to small cap. But having said that, like 2 years ago, we owned probably like 40% large cap in our portfolio. That number's come down closer to 20% now. So there's a lot of gaps. So, if you think of where we were 2 years ago, we are much, much lower. And part of this has happened just by performance because the small caps have done so well that their weight keeps going up every month if we do no action on it. So I think the next 6 months, the trend is going to be reduce the small cap and increase the large cap in the portfolio.
Right. So talking about large cap and trying to what to say, align it with your strategy of hidden value or undervalue when the market gets worried about large caps. I can take one of the most current examples is HDFC Bank. Everybody got worried. Even yesterday, the CEO very clearly said that we are not going to disappoint. Do you look at those kind of opportunities which come your way?
Yeah, so for us, our whole CU's philosophy automatically, a lot of the schemes which we do guides us to that. So it's like, 3 years ago, and, I don't split the banks into, people always have this public sector versus private sector. For me, it was retail banks versus, the corporate banks. And 3 years ago, we took the call that the corporate banks is where, the bigger value is, because retail banks had done very well, so they had outperformed. Retail banks had become very expensive relative to the corporate banks. The corporate banks were undervalued, and the retail banks were overearned and the corporate banks were underearned. And so, that was the call we took, that, it's the corporate banks where we want to focus on, though the whole market is focusing on the retail banks. And, in the last 3 years, that worked out very well for us. So for us, it is, we are always getting into space which is not the most common known today, whether it is the large cap, whether it's the mid cap, or whether it's the small cap. That's the way we think. And we get very worried of high valuation. So we typically get out early of stocks. We get in early into stocks, we get out very early into stocks.
I think that is a lesson for many investors. You have to get in early and you have to get out very carefully. I think once sold, you may not get that price. Selling is tougher, I suppose. Jyoti, thank you very much for all the insights and wish you all the best. Thanks for watching NDTV Profit.